Welcome back. You're watching Closing Trades and breaking news coming in from Mahindra and Mahindra. They're going to sell the truck and bus division to SML Mahindra, which is a subsidiary of listed subsidiary of Mahindra Group, for total consideration of 525 crores. And that is done through a slump sale. To give you a perspective, the truck and bus division has a total income of roughly around 2,989 crores in FY26, representing nearly 2% of the total income from operation, and that's something which is is going to be transferred on a slump sale basis. As per the audited financial statements of the company, the company's investment in the truck and bus division stood at approximately 481 crores, constituting nearly 0.65% of the company's total net worth. So basically, almost at book value is what the transfer is happening. It's a business transfer agreement done. And is expected to close, expected to be executed on or before 7th of August. So that's an announcement which is coming in from Mahindra. We should also show SML Mahindra, because that this transaction gives them roughly around 3,000 crores of top line going forward. And SML Mahindra is up nearly 17% in today's trade, and that's something big which is coming in at this point in time there. So important announcement coming in from Mahindra with respect to the truck and bus division. So basically, they're trying to the CV part of it has been sold out to SML Mahindra, so that they have a clear business line going forward there. But if you look at the Mahindra stock, is down nearly 1.6%, and SML Mahindra is up nearly 18% in today's trade as we speak. Do we have a guest? Okay, so let's look at once again what the announcement is, and it's basically sale, transfer, and disposal of company's truck and bus division, together with its employees' assets, intellectual properties, licenses, as a going concern on a slump sale basis to SML Mahindra, which is also a listed company and where Mahindra has a majority stake, for a consideration of nearly 525 crores. And we have with us our research analyst Avi joining us. Avi, give us some more information on this transaction.
So big news coming in for Mahindra and Mahindra, wherein they have agreed to now sell the truck and buses division to SML Mahindra at a deal size pegged at 525 crore rupees. They will be selling this via a slump sale and will be given to SML Mahindra, which is a listed subsidiary of Mahindra and Mahindra. The business transfer agreement to be signed by 7th of August and the deal to close by 31st Jan 2027. So why does it matter? It matters because it consolidates Mahindra's entire truck and bus division under one entity, which is SML Mahindra, and creates a comprehensive CV portfolio of light, intermediate and heavy trucks and buses under the SML Mahindra listed entity. This also simplifies the group structure for Mahindra, as it avoids internal overlap between M&M's CV portfolio and SML Mahindra's CV portfolio. So this will now streamline the entire CV portfolio under SML Mahindra. So what is the business impact of this deal? It is not very significant, as the trucks and buses division contribute only 2% of M&M's overall top line at around 2989 crore rupees. So which is not a very significant percentage on the overall top line. But for M&M, it continues to manufacture the trucks and buses on a contract manufacturing basis, so there is no disruption of production. But for SML, it is very significant, as it now enhances the broader market coverage, stronger product portfolio, and leadership push in the LC and CV space. So it is a strategic fit for Mahindra and Mahindra, as it builds on M&M's 2025 acquisition in SML for a 58.9% stake that it had acquired back in 2025 in SML. So it is a natural step to synchronize and synergize the SML Mahindra acquisition, sharpen its focus, and unlock synergies in the SML Mahindra segment, wherein it will now do a slump sale of the trucks and business division for a deal size worth 525 crore rupees. So big news coming in for Mahindra and Mahindra.
If you look at the kind of sales that this division did, is around 14,832 units, which was done in that sense, and that's something which is there. But aside of the Mahindra thing, you have Asian Paints numbers are also flashing on your screen. The numbers saw a decorative business volume of nearly 9%. So that's also something which is important. So let's have a look at what's happening at Asian Paints. The stock up nearly 3% in today's trade after the earnings have been announced. EBITDA margin at 20.6% versus 18.2%.
Yeah, 18.1% was the estimate, Sajid. So it's a resounding beat on the margin count. EBITDA above the 2,000 crore number. The expectation was 1,839. So surely a beat with regard to the Asian Paints numbers. PAT at 1,500 odd crore versus the 1,240 crore number, which has been clocked, or which was the expectation, I beg your pardon. So it's a clear beat with regard to the numbers. 1,539 is where the PAT number has come in at, which is very, very solid compared to the expectation. Again, the top line, I want to quickly try and pull out what the revenue number was. 10,000 odd crore was where the revenue estimate was. I'm going to quickly try to pull out that top line number. The revenue number stood at 10,542 crores. So that's a 3% odd beat on the top line. So it's not top line driven, it's surely margin driven. And in an otherwise difficult quarter where crude oil has been fluctuating, Asian Paints has delivered a very solid set. 20.6% on the margin count certainly signals recovery, at least at this point in time. We'll quickly have a guest in a minute or two with regard to that Asian Paints number. 9% growth on the volume front overall is what Asian Paints has clocked. And this is the best margin that we've seen Asian Paints clock since Q4 FY24. That's just the gravity of the manner in which they've delivered these numbers. That's Asian Paints for you. But Kunal, very quickly, he's obviously, thanks for joining us first off. How's Asian Paints looking like on charts?
Yeah, I think it's a good sign that the stock is finally coming out of a minor patch of underperformance or consolidation. The last 2 months, the entire month of June and July, for example, the stock was stuck into a 200-point range, 2,600 as a base, 2,790 as a resistance, and it looks like that the stock is trying to eke out a breakout for itself about this 2,800 levels. We need to wait for a closing. The volumes, of course, today should be on the higher side because we generally see stocks when they face results. The volume activity tends to increase quite well for these individual names. But I think if we break past about 2,800 levels, this could signal a decent breakout for Asian Paints.
Okay, so that's on charts. Kaustubh Pavaskar joining us, lead analyst, ICICI Direct. Kaustubh, how are you reading into the numbers? 3-4% beat on the top line, but it's all driven by EBITDA at this point. The cost side of things is what they've been able to manage well.
Yeah, I think they were able to manage the cost on the cost front because EBITDA margins came at around 20.6%, much better than what we and Street were anticipating at around 17 to 18%. In fact, the margins, EBITDA margins came very strong compared to what the Street was anticipating. Also on the revenue front as well, they did much better. The revenue growth was ahead of our expectation by around 2 to 3%. They have achieved, I guess, 9% volume growth in the decorative paint business, and overall the value growth was around 16-17%. So overall, it was a strong set of numbers.
And the volume growth, Kaustubh, would you say largely in line with what the consensus was? Was it better? How should one evaluate the volume number?
I think volume growth was largely in line with the guidance what the company had given of around 8 to 10% volume growth. So volume growth at 9% was in line with the guided range of the company. Also, what we were anticipating, it was around 6-7%. I think it came in better than what our anticipation was. I think Street was anticipating somewhere in the range of 6 to 8%.
Okay. Kaustubh, I'm just trying to understand. It was a difficult environment, right, from a raw material cost perspective. That's what makes this beat a little more significant, you would say? This 20.6% kind of margin has not been seen in maybe at least 8 quarters.
If you look So the gross margins for performance as well, the gross margins improved by 91 bips to 43.6%. So this is despite the fact that in this quarter we have seen, substantial raw material inflation. They had taken, a calibrated price increase in their portfolio, but I think, along with that, their supply strength and all, I think they have managed well with on the all the cost parameters. So that's why we are seeing around, 91 bips expansion in the gross margins and more than 200 bips expansion in the operating margins.
And Kaustubh, you believe that the margin number looks sustainable? I know, commentary is still awaited, but what's your sense based on just reading the numbers?
It is very difficult to gauge at this junction because there is a volatility in the, global uncertainty still persists. Crude prices are volatile, so it is very difficult to gauge whether it will remain at this level. But I think the company, overall is managing its, profitability very well, and that could be seen in the results, and that's why the results are quite good.
Kaustubh, appreciate you coming in. Very short notice, but thanks so much for coming in, giving us that perspective on Paints. Asian Paints now up 4% on the back of those numbers. We'll have to wait and watch as to how the rates settle in at, but clear spike is visible and sustaining at least at this point in time. We'll slip in a very short break, come back. Plenty to speak about, by the way. We still need to take a check on how markets are looking at this point in time. And we'll probably talk a little bit to Kunal with regard to that. Take his picks as well for this afternoon. Thereafter, of course, continue the conversation. Stay with us. Welcome back, and you're watching Closing Trades here on ET Now. I'm joined by, of course, Kunal Bothra, as he is in the studio, and Deepan Mehta of Elixir Equities. Deepan, I'll come to you in just a minute or so. Quickly taking a technical check first off. Kunal, give us a sense, this 1.2% kind of move today. We've now had 3 straight days where momentum has swung in favor of the bulls. Sustainable, you reckon?
Looks like sustainable. In fact, today's day is one of the more classier day for the index because you have the market breadth advancing. You have a set of large cap names which have moved up very well. You have momentum sectors in line with the likes of IT, realty, for example, etc. Auto stocks are largely doing very well. You have come back from metals, metal sectors. We have come back from the few odd private sector banking names. So I think it's a classic mix which you're spotting today for the overall markets, and that I believe could be considered as a healthy sign. We were discussing this last week on Friday when we flagged off that crude has topped out, and this could lead to a potential bounce for the index and maybe a retest of the previous resistances. I expect at least another 100-150 points of the rally for the index to pan out over the next two or three trading sessions for this week.
Okay. Deepan, let me bring you in as well. Asian Paints, of course, the numbers were extremely strong. I wonder whether you've bought Asian Paints on the dips. Is it still a buy? Because the cycle clearly seems to be turning. There's good strength on volumes and there's good strength in the EBITDA number as well. Gross margins also getting better.
Yeah, good afternoon, and thank you for having me on your show. So I haven't looked at the Asian Paints numbers because I was just connecting with you, so I cannot comment immediately. But I think obviously the market has seen the numbers in positive light, and maybe the worst is over for the paint industry, and this amount of stability has come back. The competitive intensity has got absorbed, and now I think all the players are able to grow based on their respective strengths and based on their respective product profile and their various strategies. And Asian Paints continues to remain the market leader over there. And now I think in terms of view of returns, we can only expect returns which are in line with the growth in the profits, because I think expansion of P multiple, that is not something which will happen considering the competitive intensity. At the same time, I think that kind of the worst is over. So I would say that you could expect returns which are in line with the growth in the profits, which could be in the kind of mid double-digit kind of growth rate, 14-15% type of growth rate, which is possible. But margins keep on fluctuating for the paint industry because it is raw material intensive. And sometimes there's a lag between cost increases and passing on the cost increase. And sometimes they get the benefit where the costs come down much later, the raw material prices have already come down. But I think that in the past, Asian Paints was able to take advantage of the cost reduction and not pass it on completely. But now I think because of competition, that kind of a comfort may not be there. So I would say that it's a decent kind of an investment. No point selling out at this point of time, but I would say from a purchase and from buying point of view, I would feel there are better ideas in the market and the building material industry only.
Interesting. Deepan, I'm going to have to pause this conversation very quickly. Unfortunately, you need to cut across to the M&M management. They're speaking about that restructuring, the latest one, which has been announced. Let's cut across.
To be able to give the best value proposition and enhance product range to our customers. Next, this gives you a glimpse of the range which now can get available to both the brands through cross-badging opportunity, and the respective dealers of the brands can also start playing in a wider range, and that also helps in getting more volumes of the product which one brand has already developed once the same product gets sold in another network through another brand. Again, a lot of specialist purpose vehicles have been created which are getting good volumes by respective brands, and now that can be available to a larger segment of dealerships. Next slide. So these are the set of key initiatives which we have already started and will be further accentuated by both the brands coming together. In terms of product portfolio, I mentioned that it helps address a lot of gaps which the respective products have. Our R&D work gets focused and we get more out of the same budget with both the brands where together spending. Value engineering, a lot of learning and sharing has started happening, and now with both the businesses coming under the one roof without having any conflict of interest related challenges, we can fully optimize the IP and knowledge developed by one brand to the other brand to drive home the value engineering and cost efficiency benefits. Network synergy, the service related synergy we had already started. As we speak, close to 175 service stations have now started servicing both the brands in just last 9 months since we did the acquisition. Sourcing synergy is a big area where a lot of benefits have started coming in already. And going forward, we are looking at this along with value engineering to add significant amount in terms of the bottom line of the joint entity. Enhanced manufacturing ability. Right now, Roper plant makes range of SML. Post the transaction, Mahindra and Mahindra's Chakan plant and the Zairabad plant will continue to do contract manufacturing for Mahindra trucks and bus range. And going forward, we can leverage the existing manufacturing footprint and also relook at footprint optimization based on the efficiency and cost measures potential. Operational efficiencies I talked about, and needless to say, the big benefit also comes from by harmonizing the entire leadership. Right now, we could do only at the top level because the two businesses were lying in two different companies, and hence there was a limit to what level of leadership harmonization we could do. Now going forward, we intend to create one common team for the entire organization dealing with two brands. Next. So this is a summary of what I was talking, that without combination, there was a limit to the level of synergy unlocking which we could do. As you can see in each of the synergy ideas, and some we could do more like sourcing, but many we were not able to do more than 50 or 25%. But with combined entity everywhere except sales network. Why sales network? Because there are many cities where independent third-party dealerships have invested for both the brands. So for some period and long, they will continue as a separate dealerships. In any new vacant area, we will look for appointing a combined dealership. So barring that and manufacturing, which as I said, to ensure no disruption, to start with, manufacturing will remain the way it is right now. And M&M will do contract manufacturing for Mahindra branded trucks and buses. But rest everything will be able to fully harness and unlock the potential synergies, which itself has a huge potential to improve the bottom line. Next. So this is a summary of what we feel that through the scale benefit of both the organization coming put together, this becomes the fourth largest formidable challenger in the commercial vehicle industry, with a lot of commercial and cost synergies, which I talked about, and harmonized leadership and talent, which we believe promises very well to maximize investors' value in terms of creating this becomes the unified truck and bus platform, or a company under which all the trucks and buses businesses of Mahindra Group will come under. And with that, we will invest and take this business to its stated potential. Next slide. So this is the transaction overview. As it stands today, Mahindra Truck and Bus is a division in M&M as part of auto sector, and SML is a subsidiary. And going forward, it becomes a unified truck and bus subsidiary, SML Mahindra. The consideration is at around 525 crores, subject to working capital adjustment as set out in the BTA. As I mentioned, M&M will continue to do the manufacturing of MTBD products under contract manufacturing arrangement. And transaction subject to SML shareholders' approval is expected to be completed by end of F27.
Okay, so that's the management of M&M. We'll obviously cut across to the conversation and bring you everything that's relevant within that. But M&M on charts, Kunal, how's it looking?
Yeah, I think the short-term charts are looking a little bit more better for M&M. You know, the base the stock had formed around 3,000 mark almost a couple of months back, end of June, end of May, start of June. I think from there the stock has lifted off quite well, even though it's still not broken past about the first major resistance of 200 moving average. But I would still believe that M&M is such a quality name that it has a very strong possibility that whenever its stock comes back into a breakout of the long-term averages, the trend starts off and sets off very well for the stock in the near to medium term. So I will be bullish on M&M at current levels, and even if there's any kind of a minor dip.
And SML Mahindra is the other one. That stock is locked on a 20% upper circuit on the back of this news. We'll come to that. But Deepan, slightly more longer term. How should one look at the auto pack? How should one play it? How are you viewing opportunities within that pack from a risk-reward perspective?
So first of all, I think the SML acquisition was very positive for M&M. It was strategic and it has been greatly value accretive. The performance and the stock price has only been doing much better since M&M came into the ownership position less than a year ago or so. And this particular rationalization or consolidation is very positive. And I think that the commercial vehicle industry itself is doing very well, has got good potential from what we can see from Tata CV as well as Ashok Leyland. So from that point of view, I think this particular kind of corporate action makes complete sense. And even at these levels, I think SML one should consider, maybe not right now because it's flared up the way it has, but at some point of time when the correction sets in, or we see better performance, valuations are reasonable, you could consider the stock. Having said that, I think we remain positive on the auto industry. But end of the day, I think the kind of volume growth which we have seen, we need to temper our expectation over there, because eventually I think base effect will catch up for the industry, and raw material cost increases also will start to impact the profit margins. So although we remain positive on the longer term in the industry, I think next 3-4 quarters you may be soft, and you need to kind of pair expectations that next 2-3 quarters may not be as great as the last 4-5 quarters have been. But look, the long-term trajectory is great. And maybe at corrections, one could look at adding, if you're underweight auto, look at adding more auto shares. I think across the board, companies have done well over there, whether it's Bajaj Auto or Aisha Motors or Suzuki, TVS Suzuki or Maruti. M&M also been a star performer. So I think the entire industry done pretty well. No, you cannot pick out one against the other. It's just that the industry has done so well that you kind of wonder that when is the next kind of challenge going to come for the companies over there.
Holding Mahindra CV into SML Mahindra, and that move has led to that 20% spike in the stock price. Deepan positive as he was describing it, but said let's wait. Of course, locked in upper circuit, maybe wait. Hopefully buy on dips. Essentially, that's, I think, the message. What we'll do is slip into a very short break. Come back with more. Stay with us. Welcome back. It's been a very chirpy afternoon, frankly. Started with M&M, Asian Paints. Now we have Prakash with us on an ET Now exclusive. The Finance Ministry is likely to hold a 2-day public sector bank manthan in the second half of August. Sources tell ET Now the government will review the performance of PSU banks, discuss the next phase of banking reforms. Prakash here with all of the details.
Well, that's an important development coming in as we are learning from our sources that the Finance Ministry is likely to hold a 2-day PSB manthan in August. In fact, top leadership of public sector banks, along with senior government officials, will participate in the meeting, which is likely to be held in second half of August. The government will review the overall performance of PSB based on defined parameters. It may also deliberate on the next phase of PSB reform during the meeting. The government is likely to review the progress made on decision taken during the last PSB's month. In fact, you are aware of the fact that the government had set a target to place 2 public sector banks among top 20 global banks as part of 2047 plan, and therefore the Finance Ministry is likely to review efforts made by PSBs so far to place 2 public sector banks among the top 20 global banks. In addition to that, the terms of reference for the high-level committee on PSB reforms are likely to be discussed. In fact, issues such as cyber security and measures to address Anthropic's mythos may be part of the agenda, which may also include new measures to boost deposit mobilization and strengthen customer-centric initiatives. A very significant development at this point in time.
All right, thank you so much for that, Prakash. Of course, that development coming our way as well. Nagaraj Shetty joining us of HDFC Securities this afternoon. It's a very decent uptick, 290 odd points now on the Nifty. Nagaraj, how are you looking at it?
Hi, good afternoon, Harsh.
Good afternoon.
Nifty has witnessed a fantastic up move in the last 3-4 sessions, and 2 back-to-back opening upside gaps in the last 4 sessions, indicating the strength of an uptrend. And the another evidence is that Nifty has broken above the immediate hurdles of around 24,000, 24,200 so far, and trading higher. The overall stage is set for the bulls to make a breakout. I'm expecting more upside towards 24,600 levels in the short period of time.
Okay. Deepan, if I can come to you with regard to results, just so many coming our way and so many moves. Well, what's really standing out to you in a market like this in terms of numbers?
Oh, that's a very broad-ended question.
Absolutely.
No, I think industry by industry, if you go, there were certain very good surprises. Like in software, Coforge came with a very good set of numbers, and Street rewarded it exactly. The management has been anyway speaking very positive about their performance. The acquisition which they have done has worked out very well for them. And somehow I think they're able to manage the disruption caused by AI far better than some of the other companies. So then when it goes to the banking industry, I thought that IDFC First Bank and AU Small Finance Bank came with very good set of numbers. I think they'll be able to manage to grow the loan book and a lot of other parameters far better than the rest of the industry. Then if you go to the next industry, like say maybe which industry comes to mind?
Sorry, I'm probably I've pushed the wrong button, but trying to get a sense on IT itself. How should, therefore, now that Coforge has run up the way it has, would you probably go out and buy Coforge? Would it be some of the mid caps you prefer? Would it be the large caps? What's the preference with regard to IT?
I think IT is going to become very selective, and companies like Coforge, Persistent Systems, Happiest Mind, Oracle, I think they're the ones which may be the winners over there. And large cap IT, I think, is still stumbling, is not able to find its right position within this AI world. And that may continue for some more time. So bearish on the entire sector per se, positive on only a few companies, and maybe outliers could be sector-specific giants, like say Tata Elxsi or KPIT, which have got very sector-specific kind of expertise. They may be able to do well, although their performance also last 2-3 quarters have been very disappointing. But I think that they will be able to manage eventually. Having said that, all of these companies, we and our clients will be invested as a measure of disclosure.
Okay, Deepan. Thank you so much for giving your time. I know, it's been a crammed show, frankly, but thanks so much for coming in and giving us that perspective.
Thank you.
Okay, excuse me. Going across, Aisha is here with some of the stocks that are in news at this point of time.
Yes, Harsh, afternoon. And let's start with Devyani International because it has reported stronger than expected set of numbers for the quarter gone by, which is why the stock is gaining in trade today. We have profit, which is coming at 14.5 crore versus 3.5 crores that the company had reported same time last year. So manifold expansion on the profitability front. Revenue up 16.5% and EBITDA margins have also expanded to about 16.1% versus 15.2% that the company reported same time last year. Very strong set that has come in from Devyani International versus 12.6% that the company reported same time last year. Let's also talk about Adani Ports because it just reported its numbers an hour back, where net profit for the first quarter rose by 9% YOY. Revenue jumped by 19% on a year-on-year basis, and this was led by cargo and logistics segment growth that the company reported for the first quarter of FY27. Higher cargo volumes and logistics in the quarter gone by aided numbers for the company. Colgate, meanwhile, has reported largely inline set of numbers with EBITDA margins at 30.1%. EBITDA expectation was 481 crore. It has come bang in line with expectations at about 483 crores. Lastly, let's also talk about V-Guard, which has reported inline set of numbers with profitability, in fact, shot up nearly 70% on a year-on-year basis, and EBITDA margins have also expanded from 8.4% same time last year to 10.5%. So V-Guard and a couple of other earnings reaction stocks that are buzzing in focus in trade today.
Absolutely. Thank you so much for that, Aisha. In fact, Adani Enterprises, you can see the numbers on your screen. There's a one-time loss there, by the way. We'll quickly have that flashed as well. 2,644 crore is the exceptional item sitting in Adani Enterprises. I'll quickly try and peruse as to what exactly is it. Well, the nature of it is, you've got the US Office of Foreign Asset Control, which has this 2,644 crore is basically the settlement which Adani Enterprises has made, and as a result of that, you're seeing the knock on the profit. But outside of that, it's a very steady quarter. So if I were to look at the profit before tax number, that's come in just shy of 1,300 crore. But the top line is where really the game is. It's gone up from 22,000 crore to 33,000 crore. So you've seen a strong uptick in terms of revenue from operations, and the PBT number has come off from last year's number, same quarter, 1466 to 1295. And there's a one-time knock of around 2,644 crore, which is reflecting and impacting profitability of Adani Enterprises. That's how, you can see that by the reaction, not too adverse at all, despite the profit turning to loss for the company. But what we'll do is to a very short break, come back, talk more, take a few stocks on charts, including an Adani Enterprises. There's also a Honeywell Automation, a Thangamayil. We'll talk about some of those names because you've seen some massive moves on some of those counters on the back of earnings. Welcome back. We have with us, of course, Nagaraj Shetty waiting by patiently and Kunal Bothra. Now, before I carry this conversation forward, I want to quickly ask them for their picks as well, because last 44 minutes odd of trade this Wednesday afternoon. Kunal first, your picks?
So I'll go with first a buy on Prime Focus. That's a chart which is looking attractive, trading above 300 plus levels. Looks attractive for a near-term target of 325. Stop loss could be kept at 298. The second would be a buy on Bector Foods. This stock is trading closer to 214 levels, confirming a flag pattern breakout at the current juncture. So would look at a target of at least 230. Stop loss to be kept at 205.
Okay. And Nagaraj, yours?
I have two stocks. One is Ether. Ether has been showing in a consolidation phase, now currently placed at the edge of a breakout of the consolidation. A larger degree higher tops and bottoms is indicating the overall medium-term trend remains intact. Currently trading around 1497, 1498. One can look to buy at this point of time. Immediate target would be 1575. One can place the stop loss at 1455. Second one is Supreme Industry. Supreme Industry has been a sharp downtrend over the last few months. Recently witnessed sharp fall and sharp V-type recovery, and currently showing consolidation. Now placed at the edge of a breakout of the important hurdle, somewhere around 3500 levels. One can look to buy, currently trading around 3495. Immediate target would be around 37 and 3700. One can place a stop loss at 3400.
Okay. All right. So those are the picks out of the way. I want to try and understand what's playing out in IT, because that's where the strength really emerged from at the start of this week, right, Kunal? It was IT, and then it's been followed by the others. Give us a sense, where are we at, where this trend with regard to IT is concerned? Is this going to be a larger trend which is likely to play out? Where are we? Is short covering still happening? Are we done with that? Is buying starting? What are you seeing in terms of the trend?
So the first move generally is short covering, because you look at it this way, the last, let's not go far, but just the last 4 months prior to that, the IT index had sold off almost 30% in the last 4 months, from 40,000 on the IT index. We had fallen down to, I think, around 26,000 mark for the Nifty IT index. Now, in the process of this 30% correction, there were a huge amount of shorts which are being built up into the IT names. The narrative was extremely negative, etc. This month so far, the IT index is up 18%. But then relatively, when we look at this from the highs of 40,000 just 4 months back, we are still down by almost 18% at the current juncture. So that tells you that that the IT index has a scope of big recovery, even going further. Now, the first leg of price recovery which happens for sectors or indices which come out of this kind of a major sell-off is, of course, on the back of short covering. What follows post a short covering is maybe few odd weeks, few odd days of a sideways patch where the stocks consolidate. But then the second rung of the rally is where you see delivery-based buying happening into the sector or the indices. So I believe that we are yet to see phase 2 for the IT index in terms of rally. We've just maybe completed sort of wave 1, phase 1 for the IT index, where you're seeing a strong short covering at play over the last few days. Maybe I think over the next few days, you might see the index consolidating a little bit, but that would probably give a further fillip or a leg up on the upside.
Okay. So there's still more to go. Nagaraj, do you have a view with regard to IT and excuse me, stocks? Which are your favorites within that IT pack?
Whole host of the IT stocks are moving up despite this front line. I think this is the time now to act on a front line. TCS, Wipro, Infosys are likely to be more up further, and I'm expecting further upside from these segments rather than the mid cap and smaller cap segments.
Okay. Now, just switching focus very quickly. Meryl here with some of the stocks that you want to keep on your radar for this afternoon's trade.
Right, so these are some stocks which have been seen buzzing in trade today. Starting first with KPIT Technologies, the stock is up over 6% now after reporting sort of a mixed quarter, while profit did fall upwards of 30% on a year-on-year basis, and margins as well were seen contracting sharply. The street is cheering the stronger than expected result And therein, the operational performance that the companies reported, where dollar revenue has declined 0.6%, which was, by management's word, was expected to decline around 1%. On top of this, the companies also reported a healthy $257 million deal wins in total for the first quarter, indicating a strong order pipeline and future growth outlook as well. Thangamayil Jewellers, on the other hand, is down nearly 10%. The companies reported strong headline growth. The revenues jumped 71%. But what seems to be driving this negative pressure on the stock is that higher costs have weighed on profitability. EBITDA margin has slipped to 5.3% from earlier levels. And the sharp run-up in the stock ahead of the margins and the results that we have seen is what seems to be driving the correction in today's trade. Eris Life Sciences in focus after reporting sort of a steady quarter, with revenues growing 13% and profit rising 20%. Margins for the company have softened marginally, but earnings growth and stable execution seems to be driving investors' outlook. Phoenix Mills is another name which is in focus. That stock is down after reporting numbers that have missed street estimates. On a year-on-year basis, it looks like the company has performed quite well with steady growth. But estimates is where the company has not been able to perform, and that's why we're seeing this sort of pressure in Phoenix Mills as well. So these are some stocks which have been buzzing in trade today, mostly on the back of their first quarter results.
Okay, thank you so much for that, Meryl. Nitin Raheja joining us of Julius Baer India. Of course, Nagaraj still continues to be with us. Nagaraj, some of the jewelry names, right? Nitin, I'll come to you in just a minute. Please bear with me. Some of the jewelry stocks, right? Nagaraj, you've seen some very decent traction in recent weeks on some of those names, Kalyan and the like. What next, and any favorites within that? Also, this 10% downtick on Thangamayil, not looking pretty.
Thangamayil is not looking that great. It has had a good run and showing some decent downward correction from the higher levels. On the other hand, Kalyan Jewellers has showed some minor decline, minor downward correction, and bounced back very well from the lower levels. The overall chart pattern of the Kalyan Jewellers is looking very strong at this point of time. Though placed at the higher levels, still there is no indication of any reversal building up. I think this is likely to move up further for these stock prices.
Okay. All right. Nagaraj, thank you so much for joining us, giving us your views this afternoon. Nitin, hi, great having you. Let me start off with ideas. What is it that you're looking at afresh at this point in time? You've seen a significant rally in IT stocks since the last time we spoke. How is it looking?
I think what you're really seeing in IT stocks is some amount of sector rotation that has happened. I think it's too early to call it, because if you look at the commentary that has come out with most IT companies, the path ahead is not very clear. But clearly, I mean, from a multiple of 21, 22 times, they're down to 14, 15 times. They have dividend yields of 4 or 5%. So I think we are seeing, and as question marks on the whole AI capex trade unfold, you are seeing some amount of sector rotation or sympathetic buying that is taking place in IT services companies. Our own view is that, look, there is some element of value buying which will happen, but for it to sustain, I think IT companies yet the path ahead is not very, very clear. So I think we will see this more as a short-term tactical trade.
Okay. Do you play the trade now, Nitin, if you haven't already played it?
So, we are, in our portfolios, we are actually taking an equal weight position. We are not really going overweight on that. And a lot of the trades that we normally play are long-term strategic themes. So, from a tactical perspective, we are just equal weight on it.
Okay, equal weight. Remain sanguine. Kunal, very quickly, the Adani Ports, Adani Enterprises, the Adani twins within the Nifty 50. Is there a call there? I mean, Adani Ports has taken a bit of a knock on the back of numbers. Numbers were, no complaints per se. But give us a sense. How are you looking at it on charts?
See, it's a mean reversion for these stocks because they've had a fantastic uptrend from their March-April lows. Adani Enterprise, for example, moved from 1800 to 3200. Adani Ports, in a very similar time span, moved from being a stock at 1300 to almost 1900. So after this 30% to 50% kind of a jump in a stock price, you're bound to see some bit of a cool off, especially once the results or news flow is out. But I would actually believe that if there's a 2-day, 3-day consistent correction into the stock price and they fall somewhere around 5% to 7% broadly in the similar kind of a time span, 3 days on a very short-term basis, that actually throws in a good opportunity where traders could look at a contra buy. So I would not be bearish on the Adani group of names. Maybe just about be a little bit more opportunistic, wait for a further drop into the stock price to go for maybe a contra buy at certain price points.
Yep. Okay. That's the texture. We'll slip in a very short break. Plenty to talk about, viewers. So you want to stay tuned. It's going to be a very interesting last half an hour. We're right in the thick of earnings and you're seeing those stocks move. Asian Paints has cooled off from the highs of the day. And KPIT is up 6% again on the back of numbers. So we'll talk about some of those on the other side. Stay with us. Now you've got plenty of earnings coming your way as well. But before we quickly take you through some of the numbers that have come today and some real strong ones as well as weak ones, let me go across to Avi. He's here with what to expect from Aisha Motors. Strong quarter, by the way. That's what's being penciled in. Avi here with the details.
So Aisha Motors is going to come out with this Q1 FY27 numbers, and let's have a look at what we are estimating at ET now. We are estimating the revenues to be around 6358 crore rupees, which would be a 27% increase on a year-on-year basis, with EBITDA coming in at 1520 crore rupees. What is important are the margins coming in at 23.9%, which will be flattish on a yearly basis and a 1% decline on a sequential basis. The profits are expected to come at around 1400 crore rupees. The volumes for Royal Enfield are expected to be in the range of 330,000 units for the quarter gone by. Some of the factors are at play is that the Royal Enfield domestic volumes have grown very strongly on a yearly basis, but the export markets have remained softish. The price hikes that the company has taken has helped the realizations for the company, but the commodity cost inflation might impact the margins. So margins is something that will be on the cards for the investors to watch out for. The VECV margins are also expected to be under some pressure following the commodity cost inflation, and the capacity expansion that the company has taken will help the company scale up its volume. So what are some of the things that you should look out for in the results of Q1 FY27? First one being the demand outlook, including the export demand outlook and the margin trajectory that the company posts. So margins, whether they come in at 23.9% and whether they see an impact of commodity cost inflation or they're still able to uphold their margins. The further pricing actions that the company might take to maintain the realizations and the series of product launches that they will announce. So this is some of what we are estimating at ET now, with revenues coming in at 65 crore rupees and margins something to look out for at 23.9%, which is our estimation.
Okay. Thank you so much for that, Avi. Kunal, how should one play auto at a time like this? You've seen a decent run up. It's very stock specific. I know you were bullish on Hero, for example, towards the latter half of last week. That has played out decently well. But what next?
See, I think now a major part of the rally, at least the initial rallies behind for the auto names, because what has happened for the auto index is there was this gap from the month of March, when the war actually started off, and that gap for the auto index was around 28,000 levels. Now today, in the process of the auto index hitting that 28,000 mark, we've actually filled the gap completely. So which means that we could probably be in for some bit of a mild cool off or a correction for these auto stocks or a consolidation for the next couple of days. So for someone who's looking at it as a short-term time frame and wants to time the entry, I think it's better to just wait for a couple of days, because I would sense that maybe there could be a stock-specific cool-off which could happen into the auto pack, and that could throw in a good opportunity. And in case of these auto stocks, say drop in somewhere around 4-5% from their recent swing highs, 2-day, 3-day swing highs, then I think it's a good price territory to try and enter into these names.
Okay. Nitin, I wonder, how do you look at auto? And, I'll just quickly highlight a couple of numbers before I come to you, Nitin. Craftsman Automation. Record top line, record EBITDA, record PAT quarterly, and you've seen very, very strong growth Q1. You've also seen that EBITDA margins have held up despite the kind of growth that they've seen. I'll quickly pull out the numbers in just a minute, but Craftsman was one of them. There's also Car Trade, which is more of a platform play, but that one also came out with numbers. Nitin, Auto Ank, two-wheeler, four-wheeler, CV, how should one play? Nitin, I believe you're on mute. No
Sorry,
worries. No worries.
So we like the entire pack. We have an overweight position on them. We think the auto sector, at the beginning of the year, once the West Asia crisis started, actually corrected. If you see a lot of the auto players, some of them are down anywhere from 15 to 20%, the OEMs, especially within the passenger vehicle segment. I think they present an opportunity because volumes have been strong. So whether it's two-wheelers, in fact, two-wheelers, we've seen, we like the players who are much more diversified, who, beyond India also have a global play. We like the EV players within that pack. And, from an auto ank perspective, I think these companies have been diversifying their product basket. They've been increasing their TAM, and they've been going beyond India. So as a whole, we like the sector and we like to be overweight in this sector.
Okay, the other one, Nitin, that really stood out between yesterday and today is consumption. HUL, that initial knock of 7%, and thereafter the rebound this morning, and nothing's changed per se. I mean, the numbers and all remain the same. But you believe that was a bit overdone, and how are you looking at consumption? Just give us a sense while we speak about auto. How does consumption look?
This has not been individual to a particular stock. One of the very interesting trends that I have been noticing throughout this result season has been this fact that on result day, whenever the results have been declared, the stocks are down. And immediately after that, in the next few days, you also see a recovery. And this is not with respect to one stock. We have been seeing this sort of a pretty unique pattern in this result season with this across sectors, whether it's been IT, whether it was with respect to some of the consumption names that you talked about, and so on and so forth. So it just seems like and stocks which have actually been beaten down prior to the results have actually seen a sort of a sympathetic bounce back. So it's in pattern with the overall market, which is trading in a range. So you have this market which seems to be going up, going down, but it's within a range. And I think some of these stocks are following through on that. Because if you look at the results purpose of a lot of these companies, especially in the consumption space, and today we've had one of the retail play, it's the same pattern. The results are not really bad. It's just, a sort of a stock reaction that takes place or a sell-off that takes place on that particular day with a quick bounce back over the next few days.
And also, I want to try and weave in your view also on some of these QSR names. There's so much focus. Mrs. Bector is being bought by a mutual fund, marquee mutual fund of sorts. Thereafter, you had this entire buzz on the stock. Today also, you had Devyani International's numbers, very, very strong set. Is this under-owned, underappreciated kind of a pocket, you believe, Nitin, QSR?
I think there is a comeback in the QSR sector that we are seeing initial signs of. This was a very, very highly fancied sector, if you remember, a few years back. And then you had slowing growth and high valuations catch up with the sector. And we've really seen a huge consolidation in terms of prices, in terms of valuations over the last 2 or 3 years. If you read the commentary that some of them put out in the annual report, and also in their results, they've all talked about a comeback in terms of same store growth or volume-led growth. So I think that sector is considerably overowned, and the market is looking for sectors which have consolidated and where there is an initial sign of growth, and you are seeing that rotation happening. It's early days, mind you, as a word of caution. And valuations are not the cheapest yet in this sector, despite the correction. But clearly, I think we are seeing interest levels flow back.
I'll take a cue from what you said in your previous answer, Nitin. Try and quiz Kunal. Kunal, I'm going to just throw some stocks at you. Give us a sense as to whether you should buy the dip on some of these, because some of these are really beaten on the back of earnings today. There's a PNG, for example, down 4%, which I believe, Nitin, you were referring to. There's Reflex Industries, there's Sharda Cropchem, which is down 6, and there's Thangamel, which is down 10. And any of these at all looking good to buy today? Probably hoping for a bounce maybe tomorrow, buy today, sell tomorrow types?
Not really, doesn't look like, because I think Thangamel, for example, is at a lower circuit since the I think since noon approximately. So which means that there could be a possibility that the stock may see a further cool off tomorrow. For the other name which you mentioned, Reflex, also I think on the short-term charts, you're looking at the stock going through some bit of a pain. PNG Healthcare, I think that's also another stock which has now made a fresh 52-week low or maybe a multi-month low at the current price level. So the chart patterns are not attractive to calling for a buy. We go in for a buy or buy on dips into stocks where the erstwhile trend has been very positive, and when these stocks generally are on the verge of an ending phase of correcting a mean retracement or a mean reversion. That's where a better trend or a contra buy originates. So far, doesn't look like for the names which you mentioned.
Okay. Also, platform companies, Kunal, Swiggy, Zomato, Swiggy's moves last couple of days. I mean, it's such a sharp move. I mean, how quickly the market changes, right? Both in terms of sentiment as well as in terms of the moves itself. But give us a sense on this one, on charts.
But Swiggy has traditionally been a very high beta stock. Now you compare Swiggy with Eternal, Swiggy's beta or the average true range, which is a statistical measure which we look out for, is tad bit more as compared to Eternal, especially in terms of the volatility. And that's why I think Swiggy generally has this effect that whenever the stock goes into a breakout, it shows those initial signs of a breakout, suddenly goes through a correction, and then gets ready for the second round of a up move in terms of a breakout. So I think that second round of up move now for Swiggy seems to have started off. It's good to see, I think, Eternal holding on to the 300 plus levels. So this should bode good confidence across the sector as such. I would believe that Swiggy over the near term could probably head towards at least the 310 to 325 levels over the very near term, say potentially over the next 3 to 4 weeks.
310 to 325, so plenty of upside left here. All right, and that's the take coming in on Swiggy. So it's Swiggy over Eternal at this point of time, right, Kunal?
Yeah, so I think as a fresh trade,
yes.
Swiggy is a better one, but I think Eternal is something which I've been bullish on earlier.
Wow, okay. Perfect. All right. So that's how we're set up. Platform companies, Nitin, are you favoring any of them? Are you liking any of them? Swiggy, Eternal, even the Car Trade, which came out with a decent set of numbers today. Stock is down maybe 3-4%, but the kind of run up on Car Trade, I mean, it was a 300 rupee stock not too many years ago, maybe a couple of years ago, currently sitting at 3,000 a piece.
I think it's more, if you look at these platform companies, the key element out there is the fact that the competitive intensity that was being factored in and had resulted in a correction in prices of the company, especially in the quick commerce space, given the fact that the incumbent challenger is struggling with its valuations and fundraise, and the leader has actually moved to a path to profitability, is starting to see the fact that the fears of the competitive intensity were while being there were higher than what has transpired on the ground, and hence you're seeing a return of interest in these businesses. We like the space, and we are positive on that.
Okay. All right. We'll swim in a very short break. Come back. Very engaging conversation. Plenty to talk about as well. Stay with us here on ET Now. Welcome back, and plenty to talk about. KPIT Tech being one of them. The stock has surged on the back of the Q1 numbers. Margin pressure, though. Darshita here to break down the numbers for us.
Right, KPIT Tech had already prepared the street for the weak quarter. In its business update release, the company said that they are guiding for 1% decline in the US dollar revenue due to the project-related headwinds. However, the actual results offer a small positive surprise. US dollar revenue declined by only 0.6%, which is better than the company's own guidance, with the management stating that the quarter one performance came in slightly ahead of the outlook shared earlier. Now, that said, the overall quarter remained weak. While the revenue were broadly in line with the expectations, the EBITDA, EBIT and the PAT missed the estimates, with margins coming under pressure because of the lower revenue and an unfavorable business mix. Now, looking ahead, management remains optimistic. It says that the deal pipeline continues to be healthy, particularly in the product and solution business, and expects stronger growth in the second half of FY27. Now, on the margins as well, the company believes that the profitability will improve sequentially every quarter, supported by better revenue mix, business growth and the AI-led productivity gains. So while the quarter one was a weak quarter financially, the focus now shifts to whether KPIT can deliver its H2 growth and margin recovery as promised.
All right, so that's with regard to KPIT. Let's quickly take a chart check on this one. Kunal, KPIT Tech on charts.
So it's still not one of the strongest name on the IT pack, but then it's started to show signs of recovery. There has been a huge gap resistance for KPIT Tech, right from the likes of 670 falling down towards almost 600. So it's now managed to enter into this gap territory, but it's still yet to break past about those 670 levels as a barrier. Today's high, for example, for KPIT Tech is 662. So we need to see a stronger evidence of a breakout of the 670 or maybe a 675 breakout for KPIT Tech. This could determine potential change in prospects for the stock in the near to medium term.
Okay. Any of the ER&D plays, is that a space you would venture in, Nitin? Because you're not exactly overweight IT. You're in fact just about equal weight, it seems. Would ER&D be something that you would fancy?
At the present moment, no. We most of our weightage is towards the larger names in the sector because of the sheer correction that they've seen, and in some of the mid-cap names.
All right. Okay, so that's the tilt. Nitin, what else are you liking in a market like this? What is looking opportunistically good? Maybe not immediately, but from a medium-term perspective.
I think what you're also seeing is with the global sell-off in the whole AI capex trade, you're seeing a correction in some of the companies in that segment. If you look at it on a month-to-date basis, a lot of the companies in the power ecosystem have corrected, close to anywhere between 10, 12% to even 20%. I think this is a longer-term play. India has just started the whole data center capex story. So I think you will see opportunities and growth coming there. And this correction could actually, be a good time to start looking at some of the stocks out there. We continue to like consumption and more so premiumization of consumption. Whether it's consumption services, which includes hospitality, aviation, and so on and so forth, which should continue to do well as such. And of course, there is the whole private banks who have actually seen a sell-off post their results. We think the valuations, some of these banks with 15% return on equity are growing their books and are trading at, have come down to price to books which are historical lows. I think clearly we like some of those stories.
Okay. All right. And private sector banks in particular, do you like the larger ones, Nitin? Would you venture down the market cap curve to look for opportunities where there could be a large re-rating in terms of ROA for FY27?
We like both. We think we would have a mix of both.
Understood. And what about mid-cap banks? Where there's been plenty of chop and churn in terms of promoter ownership or top management, the likes of RBL, Federal and the like. Would you, even IDFC First for that matter, no change there, but broadly there's plenty moving in around that. So banking as a whole, Nitin?
Yeah, so we think that, look, the worst is behind for most banks. which is A, with nominal GDP expected to be in double digits this year, credit growth expected to go back to anywhere around 14 to 15%. The interest rate down cycle over and behind. We clearly see that, and plus adequate liquidity in the system. We see, I think banks have, a good headroom to grow. And, we sort of like the entire sector, but of course we would pick and choose banks between some in the large cap, some of the second tier ones, who have actually, by the way, done very well in this quarter and delivered some very, very strong numbers. So we would probably play across on a bottom up basis.
Banks, Kunal, I know that you don't fancy them, but could things change just given the kind of momentum that's building up in the market, at least today, which is visible?
Too early to say that, Harsh, because I think it's just one of days where you see the Bank Nifty showing signs of slight bit participation. But even with this 400-point uptake for the Bank Nifty, it's been a slight underperformer with respect to the benchmark indices, where you're seeing the Nifty up 1% plus. The Bank Nifty is up just about 0.7, 0.8 approximately. So that tells you that even though the performance is on the upside, but it's still a tad bit on the lower side when you try and compare this with respect to the benchmark indices. The bigger concern for the banking names is the immediate reprieve which you are unable to see for those large cap heavyweight banking stocks. And I'm not just including the private sector banking names, even the PSU banking major like SBI, for example. The fact that these stocks are unable to lift off to any kind of a big breakout, see signs of trend, durable recovery for themselves, makes the rally in the Bank Nifty a little bit more questionable. The more important part is that even after this 400-point rally today, the Bank Nifty has been unable to surpass above its 200-day moving average. So this could also be a big question mark that maybe over the near term, the trend for the Bank Nifty could improve once we break past about those long-term averages, which till now it hasn't.
Okay, all right, that's on the Bank Nifty. But M&M will be expected to come out with quarterly numbers tomorrow. Let's quickly go across to Avi. He's here with what to expect.
So Mahindra and Mahindra is going to come out with the Q1 FY27 numbers, and let's have a look at what we are estimating at DT now. We are estimating the revenues to rise by 23% on a yearly basis, coming in at 41,762 crore rupees, and the EBITDA to rise by 9%, while the profitability, which is the PAT, to rise at around 3%, coming in at 3562 crore rupees. What is important to look at is the margins that M&M comes out with, as we are estimating around 1.5% of margin contraction at 12.8%, down from 14.3% last year. So margin is something that we would be looking out for. The volumes are expected to be good, coming in at 440,000 units for the quarter gone by. So what are the factors at play for Q1 FY27? This volume growth has been very good for the auto segment as well, being driven by the exports, SUVs and the CV segment, while for the tractor segment the volumes have also been very good. The company has taken price hikes which have been able to partially offset the commodity cost inflation that the OEM is facing because of the West Asia crisis. The margins is something that we would be looking out for, and what is the kind of commodity cost inflation impact that has been on the margins. But the higher EV mix that Mahindra has is also weighing on the margins. So some of the key things to look out for in the earnings for Mahindra will be the demand outlook, both for the auto and tractor segment, the margins impact that comes out for the published numbers because of the commodity cost inflation, the new product launching timelines, at what timelines will the new product launches will come, and the volume guidance that they give for both their auto and tractor segment. So all in all, we expect a decent set of numbers from Mahindra with good volume growth, but something to look out for will be the margins in the Q1 segment.
Okay, thank you so much for that, Avi. In fact, Sirma's numbers have just come in. I'm going to quickly try and pull those numbers out. Sequentially, the EBITDA is slightly softer, but typically you look at this YOY, right? And therefore, you've seen very, very strong numbers. Those numbers will just come up on the screen in just a few minutes from now. But essentially, it's very strong growth on the top line, along with decent margins, which is coming our way with regard to Sirma SGS. Margins on a year-on-year basis, last quarter, Q1 was at 9%. Currently, margins are above that 9% number for Q1 FY27. Q1 FY26, I beg your pardon, was 9%. Q1 FY27 is higher than that. So margins have gotten better. We'll keep track of that, of course. Closing minutes, though, of trade. Quick final thoughts. Nitin, outside of private sector banks, anything that's looking interesting to you?
Well, I think we mentioned about the fact that, right, we like the whole capex, power capex play, which is corrected. Besides the banks, also we like the consumption plays within the economy. We think those are, and of course, we like EMS as a sector. We think that's another sector that one can look for long-term plays.
Numbers. Nitin, I just want to prod you further with regard to capex, because two things have stood out for me this quarter. One is your private sector banks. They have suggested that wholesale lending has picked up in a very solid fashion this quarter. At least that's what is evident. The second thing is the fact that L&T said that private sector capex related orders have been strong. How do you play this theme, Nitin, in your opinion?
Well, I think you could play it through the EPC companies. You could play it through power transmission sectors. You could play it through the electric equipment companies. I think these are some of the plays that one can look at.
Okay, Nitin, thank you so much for those thoughts. We'll let you go. Thanks so much for coming in and giving us your views. All right, that's how we're shaping up. Top gainer in terms of